If you want to know, whether a recession is coming, or if an economic recovery is maybe already underway, you do not wait for the government's official unemployment numbers.
Oh, absolutely not. I mean, by the time those national payroll statistics actually drop, you're looking at a historical artifact.
Right, it's already too late to act.
Yeah.
If you want the real-time pulse of corporate confidence, you have to look at the companies that literally physically place the accountants, the tech auditors, and the risk consultants into those Fortune 500 boardrooms.
Yeah, you look at the leading edge of corporate spending. Because, well, when a CFO is nervous, they immediately freeze permanent headcount.
Exactly.
But when they start to feel just a faint glimmer of optimism, they don't immediately go out and hire 100 full-time employees. They quietly approve a few short-term consulting contracts just to test the waters.
Which brings us to today. Welcome to the deep dive.
Yeah.
Our mission today is to bypass all that delayed macroeconomic noise and just rip into a fresh, real-time scorecard.
Yeah, the Q1 2026 earnings report from Robert Half Inc.
That's exactly. Released on April 23, 2026. We are looking strictly at the numbers, the margins, and the actual forward-looking statements from their official release.
And for you listening, if you aren't familiar, Robert Half isn't just a staffing agency. They are the world's first and largest specialized talent solutions and business consulting firm.
Right. So looking at how they are performing is essentially taking a diagnostic X-ray of global corporate hiring trends. It shows us what companies are actually willing to spend money on right now.
Which is why their Q1 2026 numbers are just a fascinating study in conflicting signals. I mean, when you look at the raw top-line data for the first quarter, it's a bit jarring.
Yeah, let's get into the numbers.
So the company reported a net income of $14 million.
Which translates to, what, 14 cents per share?
Exactly, 14 cents per share. And that was generated on total revenues of $1.3 billion.
But if you compare that to the exact same quarter last year, Q1 of 2025, you see an immediate contraction.
A pretty noticeable one, yeah.
Right. Because last year, net income was $17 million, or 17 cents per share, on revenues of $1.352 billion.
Right.
So year over year, their global enterprise revenues are down 4% on a reported basis.
Yeah.
And actually, they're down 6% if we look at their adjusted metrics.
And see, a standard financial analysis would look at a 6% adjusted revenue drop and immediately adopt a defensive posture.
You'd expect panic.
Yeah.
Or at least a lot of caution.
Yeah, right. You would expect that commentary from leadership to reflect a, batten down the hatches mentality. Yet the CEO, M. Keith Waddell, his tone in the release is notably optimistic.
It really is.
He points directly to a second consecutive quarter of positive sequential growth for their talent solutions. That's on a same-day constant currency basis.
Right.
And he even highlights that these revenue trends actually strengthened as the quarter progressed into early April.
Okay, let's unpack this, because the tension between a year-over-year slump and sequential optimism is basically the whole ballgame here.
It really is.
It's like taking a trauma patient's pulse, right? The year-over-year data tells you the patient has lost significant weight over the last 12 months. They are undeniably weaker than they were a year ago.
Yeah, the long-term trend looks bad.
But the sequential month-over-month data shows their heart rate is finally stabilizing. They're holding down food.
I like that analogy.
You aren't celebrating peak health yet, but the driver of that optimism is the fact that the downward spiral has arrested. So how much weight should we actually give to this immediate momentum versus the year-over-year slump?
Well, you have to remember that in the highly cyclical talent and consulting industry, management teams live and die by sequential momentum.
Right.
So Waddell tracking strengthening trends from January through the close of the quarter and especially into early April, that is the critical signal.
It shows the momentum is building.
Exactly. It implies that client budgets, which, may have been locked in a deep freeze through the back half of 2025, are actively thawing right now.
But if Waddell is confident about sequential growth, despite an overall year-over-year revenue drop, those green shoots have to be hiding in very specific areas of the business.
Oh, they definitely are.
To figure out where actual corporate demand is concentrated, we have to look under the hood at their revenue splits. Because Robert Half's one...
Not at all. It's carved up across three very distinct operating arms, and they have vastly different margin profiles.
Let's break those down.
The largest engine of their revenue is Total Contract Talent Solutions. That brought in $725 million in Q1.
Within that contract number, the absolute lion's share is highly specialized labor, right?
Yeah, finance and accounting generated nearly 538 million of that 725 million total.
Wow. Okay, so that's the contract side. What else?
After contract work, you have permanent placement talent solutions. That generated $109 million.
Okay.
And finally, Protiviti. That's their global consulting firm focusing on internal audit, risk, and technology. And Protiviti delivered $466 million for the quarter.
Here's where it gets really interesting. Because the gross margins attached to those revenue streams look completely inverted to how a casual observer might assume a premium business operates.
Yeah, the margins are wild when you look closely. What's fascinating here is how clearly those margins illustrate the fundamental mechanics of human capital business models.
I mean, their permanent placement division operates at a staggering 99.7% adjusted gross margin.
Right, because permanent placement is essentially a matchmaking fee.
You find the person, you place them, you get paid.
Exactly. The cost of service after the hire is made is virtually zero, hence the near 100% margin. But the revenue stream from that specific client dies the moment the contract is signed.
It's a one-off.
Right. But then you look at contract talent and Protivities, and they are fundamentally different. The contract talent sits at a 38.9% adjusted gross margin.
Okay, that makes sense. Because Robert Half carries the burden of paying those wages while billing the client at a premium. But wait, what about Protiviti?
Protiviti, the high-end risk and technology consulting arm, operates at just an 18.8% adjusted gross margin.
See, I understand the recurring revenue model, but I really have to push back on that Protiviti number.
I know, it sounds low.
An 18.8% adjusted gross margin feels incredibly thin for a premium global technology and risk consultancy.
It does.
If you are embedding highly specialized tech auditors into Fortune 500 companies, shouldn't we expect a thicker margin? Are they deliberately eating costs to maintain global utilization rates during a soft economic cycle? Or is that just, I don't know, the reality of commanding high-end consulting talent in 2026?
Well, it's mostly a reflection of the intense war for top-tier consulting talent.
You just had to pay them that much.
Yeah. To field a team capable of auditing complex tech infrastructure or managing enterprise risk, you have to pay top-of-market salaries to those consultants, regardless of whether client demand softens slightly.
Right, you can't just bench them.
Exactly. You cannot easily furlough a senior cybersecurity consultant for a month and expect them to stick around.
They'll just go somewhere else.
Right. So when revenue dips even slightly, as we saw with the overall year-over-year decline, those fixed high-end salary costs immediately compress the gross margin.
That makes perfect sense. They are protecting their intellectual capital at the expense of short-term margin thickness.
Exactly.
And that actually brings us to a massive geographic divergence buried in the report. If we look at where these divisions are succeeding and failing, the U.S. and the international markets are telling two completely different macroeconomic stories.
The divergence is stark.
Yeah.
In the United States, contract talent saw a 7.5% adjusted revenue drop in Q1 2026 compared to the prior year.
So American companies are clearly continuing to shed contingent administrative and accounting labor.
Right. But if you look at their international operations, Protiviti Consulting did not just hold steady, it actually grew by 8.1% on an adjusted basis.
See, that is wild. The U.S. is cutting operational fat, but international companies are actively ramping up their spend on enterprise risk, internal audit, and technology consulting.
It's a huge contrast.
If you're managing a global portfolio, that data point alone is a massive signal. It suggests European or Asian firms might be heavily investing in compliance, perhaps bracing for new regulatory frameworks or massive tech integrations.
While American firms are still focused on leaning out their core operations.
Yeah.
Yeah.
Exactly.
And it completely validates the strategy of running a globally diversified professional services firm.
How so?
Well, a purely domestic U.S. staffing firm would be looking at that 7.5% drop and panicking. But Robert Half uses the 8.1% international consulting growth to counterbalance the domestic weakness.
Right, but if international operations are driving your growth, you suddenly have a massive currency exposure problem.
Oh, absolutely.
Which brings us to the meticulous nature of corporate scorekeeping, because we have thrown the word adjusted around several times today. Adjusted gross margins, adjusted revenue growth.
Right.
The earnings report relies heavily on these non-GAAP financial measures.
And if we connect this to the bigger picture, it is vital to understand that for a sophisticated investor, Non-GAAP adjustments are not accounting tricks meant to hide bad performance.
They're just moving numbers around to look good.
No, they are really the only way to see the true operational velocity of a multinational enterprise. Robert Half explicitly strips out two major variables to find their adjusted growth rates:
Right.
foreign currency exchange impacts and the variance in billing days.
Here's where it gets really interesting. Let's tackle the currency adjustment first. They retranslate their current international revenues using the prior year's exchange rates.
Yeah, constant currency.
It's like comparing the marathon times of two runners, but one had a massive headwind and had to run an extra mile.
Right, you can't just look at the raw time.
Exactly. You cannot compare their raw times and declare one runner superior. By adjusting for currency, Robert Half is basically trying to tell investors, look at how fast we run on a flat track with no wind.
Precisely. Because if Robert Half's UK division secures the exact same volume of consulting contracts in Q1 2026 as they did in Q1 2025, their underlying business operations are perfectly stable.
Right.
But if the US dollar strengthens significantly against the British pound over that year, the translated revenue reported in dollars will mathematically shrink.
Even though they didn't lose any business.
Exactly. Without adjusting for constant currency, an investor would look at the US dollar report, assume the UK team is losing market share, and demand executive changes, when in reality, the local business never lost a single client.
It prevents leadership from being punished or artificially rewarded. Honestly, by global forex markets, they have absolutely no control over.
Right.
But they apply that same rigorous adjustment to the literal calendar, which I find even more compelling. They adjust for billing days.
It sounds incredibly mundane until you realize the scale at which they operate.
Yeah, explain that.
Well, Q1 of 2026 might simply possess fewer actual working days than Q1 of 2025. This could be due to leap years, when weekends fall, or shifting global holidays.
Right.
When you are billing $1.3 billion a quarter, a single missing Tuesday can equate to tens of millions of dollars in top-line revenue variance.
And they do not just subtract weekends and call it a day. The report notes they use a global weighted average number of billing days.
Yeah, it's very thorough.
They are factoring in regional holidays across dozens of countries, weighted against the specific revenue generated by those specific regions and functional specializations.
It is a phenomenal mathematical smoothing process. By stripping out the noise of currency fluctuations and calendar anomalies, Robert Half is demanding that the market look strictly at their operational momentum.
Right.
And as Waddell noted, when you look at that smoothed, adjusted data, the sequential momentum from January into April is positive.
If you're a manager listening to this, ask yourself, are you adjusting your own team's KPIs for market headwinds and calendar variances, or are you punishing them for a short month disguised as a lack of hustle?
It really changes how you view performance.
It absolutely does. But having meticulously adjusted the past to understand the present, the earnings report then pivots to the future. And this is where the document reveals a really profound existential tension.
Yeah, the forward-looking statements in these filings are always legally mandated disclosures of risk.
They list all the usual stuff.
Right, the macroeconomic variables you would expect. Global economic volatility, reliance on short-term contracts, margin pressures. But prominently embedded within those traditional risks is a highly specific modern anxiety.
Yeah, the AI warning.
Exactly. They explicitly highlight the risk associated with, quote, the development, proliferation, and adoption of artificial intelligence by the company and the third parties it serves.
So what does this all mean? Robert Half's single largest revenue driver is their finance and accounting contract division, pulling in $538 million in a single quarter.
A huge chunk of their business.
And historically, a massive portion of contract accounting involves data reconciliation, basic auditing, spreadsheet structuring, and reporting.
Which is highly structured, rules-based data manipulation.
Exactly. It is the exact bullseye of what modern AI models are explicitly designed to automate instantaneously.
This raises an important question for their entire business model. AI is not just a tool for internal efficiency at Robert Half. It is a direct existential disruptor to the very core of client demand.
Because the clients won't need as many chimps.
Right. If a Fortune 500 client integrates a bespoke AI agent that can continuously reconcile their global ledgers in real time, that client's need to abruptly hire a team of 20 contract accountants during tax season just evaporates.
So Robert Half is caught in this fascinating technological crossfire. If they don't deploy AI internally, their own operational costs will overrun their margins.
Yep.
But as their clients deploy AI, the demand for their highest volume contingent labor shrinks.
That's a tough spot.
Yet CEO M. Keith Waddell counters this looming threat in the report by heavily emphasizing the company's human elements.
Right.
He specifically touts recent awards they won Fortune's Most Innovative Companies and Forbes' Best Employers for Company Culture.
Waddell frames their survival strategy with a very specific phrase. He champions the company's unique combination of award-winning high-tech capabilities and high-touch expertise.
High tech and high touch.
Yeah.
It is a brilliant piece of corporate messaging, but it is also a massive gamble because they are essentially conceding that while the raw data processing of an accountant might be automated away by the high-tech side, the ultimate value of human capital relies on the high-touch side.
Exactly. Take that a step further into their Protiviti consulting arm. An AI can certainly ingest 10 years of corporate data and instantly generate a comprehensive enterprise risk report.
You can do the math.
Right. But what an AI cannot do is sit in a boardroom, read the subtle, unwritten political tensions between a CEO and a board of directors, and use empathy and human persuasion to fundamentally alter a company's strategic direction based on that report.
They are betting their multi-billion-dollar enterprise on the premise that as technical tasks become infinitely cheap and automated, human trust, cultural alignment, and emotional intelligence will actually become premium, scarce commodities.
That's the bet.
I mean, a machine can match a candidate's resume to a job description with perfect accuracy. But it takes a human recruiter to realize that a candidate's communication style will catastrophically clash with a specific client's intense office culture.
It is the ultimate test case for the professional services industry.
Yeah.
If Robert Half's thesis holds true, the total addressable market for human labor doesn't shrink due to AI. It merely shifts upward towards strategy, relationship management, and complex problem solving.
But if they are wrong,
If they are wrong, and AI proves capable of replicating even those high-touch consulting dynamics, their entire margin structure will be under siege.
wow. So to synthesize our deep dive today, Robert Half's Q1 2026 earnings report is far more than just a ledger of revenues and net income.
It really is.
It reveals a highly complex corporate ecosystem where year-over-year revenue dips are masking a stabilizing, positive, sequential momentum.
Right.
We explored the vital importance of recurring revenue streams and contract labor and the strategic shield provided by international consulting growth.
And we also dissected the rigorous mechanics of non-GAAP corporate reporting.
League adjustments.
Yeah. Recognizing that stripping away the arbitrary noise of currency fluctuations and the literal number of days in a month is really the only way to accurately measure a multinational company's operational velocity.
Which leaves you with a final thought to mull over. We just spent a significant amount of time discussing how sophisticated companies use adjusted metrics to find the truth in their data. They adjust for currency, they adjust for calendar days. But if the world's largest specialized talent firm is explicitly citing the adoption of artificial intelligence as a major variable for their future, while simultaneously doubling down on the value of their high-touch human culture, it forces us to look at our own careers.
Yeah, it really does.
In your industry, is the future of work going to be defined by the technology you know how to use, or by the distinctly human connections you can provide that a machine never will?